Ladies and gentlemen, welcome to Fintech Insider News on Air. Firstly, a weird admission. This is my first one of these for what feels like, I don't know, 4 or 5 weeks. You know when you start something and then you disappear for a bunch of time and then you come back and they've made it better without you. So, which is good. But I'm joined today by Jason. How's it going, Jay?
It's good. Busy, but good.
I know, it's Thursday again. It comes around rather quickly, doesn't it? Which
It
is
does.
nice. And as always, we're joined by Zoe. Say hey, Zoe.
Hi guys, how you doing?
Really, really good. It's amazing how much we're packing into a week each week, and to that, we probably should crack on and get through this. So, Zoe, what's up first?
Our wonderfully loyal Bob McLean, thank you for your question.
Good pronunciation there. Should be very happy.
Well, you know, I'm nailing it nowadays. As a startup, how do you retain the core of your culture while allowing it to grow as you scale?
Ooh, good question. Shall I go first on that one?
Do it.
By actively making that happen. I think the best thing on this one, you know, people talk about the kind of overnight success type thing, like it doesn't take lots of hard work to get up to that point where you do something. So for me, the establishment of a great culture in a company happens by really, really, really hard work. In the same way as a marriage doesn't just work, you have to work at making it work. Not wanting to shout out to my wife there at all type thing, not implying we're having to work out our marriage. This is getting weird. But do you know what I mean? It's one of those things that I believe that anything good in life comes from really, really hard work, but common purposes, common goals around everybody where we're at. We were actually talking about this in a meeting earlier on today, that we kind of feel not just in the way that we want to help financial services organizations achieve the outcome of what it is that they're doing through delivering interesting outputs from the projects and programs that they're sort of leading and moving forwards. But very much this is about finding a better way to get there. We often sort of joke about it's not what you do, it's the way that you do it. And the way that you do it is by really making sure that you've got well-educated, well-understood, well-meaning people in place to make good decisions in everything that they're doing. And that's not about a parent-child relationship. That's about empowerment and putting in place a culture that actually allows people to make a predictable decision when people aren't in the room. But I don't know what you'd add to that, James.
Yeah, I think that's right. I think your point around working at it, ultimately there'll always be a culture, a set of beliefs and norms of how the organisation work, and most often that's a default. You know, we bring the cultures of the organisations that we worked before with us, and we kind of try and almost replicate that model. And sometimes we replicate it badly, sometimes we replicate it well. Sometimes we actually stand back and think about, well, what should the culture be in order for us to be a highly performing organisation? But that takes effort, and especially when you're in a startup, growing, delivering, selling, doing all of the work that you need to do, actually that can often fall by the wayside, and but ultimately does have a big impact as to what your organisation will become in the future. So it's one of those highly important but non-urgent things that I think you just have to prioritise.
It's an interesting one as well, because I don't think I'm going to name drop here really big, but as I was saying to the CEO of a bank last night over drinks, I don't believe that there's a single culture in an organisation. I believe that there's multiple cultures, whether it be, you can't expect the same culture within a design function that you can with engineering, because the purpose of those guys is fundamentally different in terms of actually why they're there and what they're there to do. So I think the commonality around the purpose of the company is critical, but I think you need to allow for the fact that actually interdepartmental cultures will be created. But so long as there's you often talk about the sort of tightly knitted, loosely coupled sort of metaphor, don't you?
Yeah.
And I think that loose coupling with a kind of tight purpose of why the company is there, let alone the departments, leads to just consistency in terms of what you're doing. But given culture is many very large organisations' most significant problem over and above architecture or technology or talent or anything, the culture inhibitors for organizations is really why a benefit from a startup. Why can a company like ours build banks quicker than big banks can build banks? Then that predominantly is down to the culture and the talent of the individuals. But it's a really interesting question, and definitely culture will keep coming back to.
Next question is one of two today from Vegan. What does the team think of comparing the market caps of two businesses with very different offerings, i.e. JP Morgan versus Stripe?
I'd say it's pretty damn foolish, really. I'd sort of say the purpose of those two companies is fundamentally different in terms of where it's there. The sort of lowest common denominator of success is usually a dollar sign or a pound sign, right? So in terms of market cap, in terms of what these things are doing, then you see it as a sign of success, but it's apples and oranges from my perspective in terms of what you're doing. I think you have to delve a lot deeper. You just can't say. It's like saying, is somebody more successful for earning £100,000 or £20,000 in terms of what they're doing? Well, it's very much down to kind of what their role is and what their purpose in life, what they want to achieve. So I'm not really sure you can do apples and oranges. But again, what do you think?
Well, market cap's driven by a couple of things. It's convincing investors of your future story of revenues and growth. And so if you can tell an amazing story that Stripe is going to be a multi-billion, tens of billions worth company, then people will value the share price higher to take that into account. If they don't believe you, then they won't. So there's a future-looking piece to that, together with a competition, with a supply and demand. How much do people really want to get into to owning Stripe versus JP Morgan? So you are. If you base these things on pure revenues and numbers of customers and everything else, then you're never going to come up with the sums that new startups are worth and the unicorns and where they're at. But ultimately, it tells you that investors buy into the fact that these startups do have a lot of promise and could become massive organisations in their own right, while at the same time many of the incumbents are likely to struggle, or some of them will fall by the wayside. So I think we're seeing investors, I guess, vote with their cash as to where they think the future will go.
It's an interesting one, isn't it? Because is the past becoming not the greatest indicator of future performance? But that would have been the a majority of you would say JP Morgan or anybody in that sphere or that size. The previous success would have denoted the increased chance of success. Yeah. But actually, with everything that's going on, sometimes now we're seeing it is easier to be a Stripe or a Klarna or somebody in that ilk to have that beachhead scale to a significant degree. I guess the challenge with not wanting to focus it too much on a JP versus Stripe thing, but I think Stripe is so synonymous with a smaller niche of things that inherently can it scale beyond albeit a very, very big beachhead that it's kind of stuck to in terms of all the payment stuff that it's doing. But I'd say JP has spread the risk so much broader across so many more products that actually they're in that I think they're playing a very different game from one another. So, but interesting question.
Question 3 is from BTR_S. How will the traditional high street banks respond to growing technology disruption and consumers switching accounts to new fintech players?
Well, I guess we should say that we're not seeing that at the moment in terms of it happening today. I think it's quite easy to be at a bank and say, well, where are all these millions of customers switching? What are the switching rates at the moment? Where does it look? That's not to say that it won't happen in the future. But I also think that big banks, small banks, and everyone in between aren't resting on their laurels. I think everyone knows that there are big changes coming. You've probably heard us talk quite a lot about a change from digitising what has come before into creating things that are digital, and from commodity products into intelligent services. And that breaks the business model, the operating model, the way you go about a lot of these things. So I think with that in mind, we're seeing two approaches. Almost a two-pronged approach with big banks. One, drive the improvement of their core business, improve their technology, bring more people in online, drive down the costs that it costs in order to serve customers, while at the same time understand that while you're doing that for in some cases tens of millions of customers, how are you developing these intelligent services, these next generation propositions? So I think we know from working with a variety of clients on both sides of that equation that is going on, and that people while they're not seeing big switching rates at the moment, while Revolut's up to 1 million customers or something, there are 65, 70 million current accounts in the UK. So we're only really just seeing the start, but I think the big banks are well aware.
I think the thing is as well is I don't think it's fintech and challenger banks taking over is not a revolution. This isn't cars being flipped in the street and people throwing stuff through windows to change overnight the sort of face of what banking actually is. For all intents and purposes, I have left my bank. My bank just doesn't know that I've done it yet. So on a day-to-day basis, I'm using the Revoluts and the Monzos to be managing my world, but the bank that I have still has a customer. Now, if they analyze all of the information and the data of actually what the level of engagement, the actual relationship that I have now with the bank that the big incumbent bank that I have an account with still, then I think it's how do they measure a customer, really? If a customer is somebody who just still has an account with me and that's the mark of success, then I think it's going to be a long time until we see those guys really fearful of it. If at the point where that happens, you've already we talk about the sort of lack of love there in terms of that scenario, but once that love is gone, and actually I think getting them back, if you suddenly see the only transactions that are actually happening in that space are somebody transferring money to a Monzo card, which we've definitely seen in lots of instances in some of the people who work at 11FS, but I think that it's a slow bleed out rather than a very quick mercy kill, I'd suggest. So
and there are some assumptions in the question. I guess you're talking about vertically integrated banks, the move from a big bank to a challenger bank. But I think more interesting in that competitive space is this sort of platformification that actually is unbundling what a bank does. In the end, you've got this sort of product engine, the place that the balance sheet sits, where lending happens from, where deposits are taken, and that has to be crazy lean and really, very low cost in order to provide that platform. And we're seeing some players coming along like Solaris or Clearbank that just specialise in that area. Then you've got the intelligent services layer, how do you take that basic data, that basic account, and make people's lives better or deliver really great real-time intelligent contextual services. And then even above that, you've got how does that integrate into a variety of other areas? How do you create an app store? How do you integrate into end-to-end journeys? How do you really sort of then take financial services and contextualize it in people's lives? So ultimately, will it be one vertical bank fighting another vertical bank, or will it be a number of providers at various different levels essentially fighting on their own and with groups in order to create dominance? And I think it's probably the latter. So I think it becomes less as to where you've switched, as to where does your money sit legally, what are the services you're using, and how do apps and integrations sit over the top of that? I think it'll get more complex before it becomes simpler.
It's going to be interesting. So where do you think I guess in that scenario that if we're in a situation where people never close the accounts because of we don't have to, and open banking and kind of everything that comes through. It's like most people don't unsubscribe to a newsletter of that they don't like, they'll just delete it. There's going to be no pain to a customer to keep a current account open that they don't use. That's actually the emphasis is it's going to be very difficult, because obviously the incumbent organizations or any organizations around we've seen this happen with not just the big banks, but N26 closed a bunch of accounts that were dormant because people were opened account, didn't necessarily get to use it as their full-time current account, and therefore it was costing them money. It's going to be really interesting to see how much of the operating cost of the organization is going to be made up of the zombie bank accounts, because the customer is gone, but the cost still remains. But we don't know. It's going to be really interesting to see how it plays out there.
Fantastic stuff. Moving on. Sent in to fin@11fs.com from an anonymous source. Which area of finance is most vulnerable to disruption at the moment?
Well, I guess you could start off by saying, how would you work that out? What are the criteria? in some ways, opacity is a big thing. If some charges are also a big thing, the number of people who are in that area. So, the area, and there are a number of areas, I'm not sure I can rank them, that are vulnerable, but they tend to be things where people are being charged, they don't really know where the money's going, there are a lot of intermediaries involved. So that's everything from, insurance, wealth management. I find crazy with the opacity of fees and charges and how all of that's working. But I think that those are the key points for me. It's a case of large numbers of customers paying seemingly large fees for predominantly digital transactions, with large numbers of intermediaries all taking a little slice. And we've seen that, I guess, play out across a number of areas, from the payment space into challenger banking, and now we're moving into sort of the SME banking world, transaction banking, wealth banking, and insurance, beyond that.
Yeah, I think that's really fair. I think we've seen many processes that we don't necessarily understand what that charge is, but we're just happy that process wasn't screwed up in doing it. Therefore, that £25 admin fee or overhead charge that we just didn't understand. And I think to your point, I think there's an interesting correlation between, we talk about that like fear of fucking up. If the customer is fearful of fucking up the process, they're more willing to be forgiving of a £25 fee for a mortgage thing that they don't understand, but they're happy they are not tethered to this thing for the next 25 years that may have been wrong. Now that doesn't make it right. And and financial services is not the only industry that does that. I think solicitors and housing, moving housing, and all these different things is subject to that, really. But I guess the thing around sort of democratization of data and understanding, and really where we're sort of moving to people being a little bit smarter about actually how these processes works and where the bear traps are from a fees perspective, then it only takes one organization to break from the pack to go, we're not doing these things because it's a bad thing in this instance. Then it starts to kind of bring about a real change. I actually feel like arguably, if we take it not just from a customer's perspective in terms of the vulnerability, I actually think IT departments in big banks are probably the most vulnerable right now, because actually I think they're in most instances being inhibited by out-of-date principles and processes, which is kind of difficult. There's this interesting cycle really of aggregation and centralization and decentralization of where control for strategy sits. If it sits in IT, if it sits in the business, who's in control of the budget. And arguably the hard thing for internal IT departments is they're usually being measured against external parties, which can move quicker and don't have the inhibitors that actually they do if they're centralized and internal. So I feel quite bad for them, really, because they're in a situation where they're not really able to compete probably in the way that they'd want to, because in many instances we come across people who know what the right thing is to do, they know the technology they would want to use to make it happen, but the organizational and the cultural and resistance to make those changes is what's arguably slowing down the performance of the transformations that we're seeing. So if I was going to say in a bank, I'd say IT departments. If I was going to say out of bank, I'd say big incumbent suppliers, just because I kind of feel like that's where the perpetuation of most of the fallacies about digital transformation is actually kind of coming from. So, digitization has been a cash cow for many consultancies for a decade. Because actually it was selling a dream to people that everything would be okay if you made these small changes that aren't a big deal. And unfortunately, the reality of the situation is now the small increments that you would have need to have made in the direction that you needed to go now is a really big leap for many players. And that move from needing to make small changes to keep yourself nimble, to keep your tools sharp, to having to make that huge giant leap, it makes this whole thing much harder in terms of both convincing people to do the right thing, but also getting the permission internally to do the things that you need to do. So there probably isn't just one. There probably isn't one area that's more vulnerable than any. But I think probably the main trend is anybody who thinks the situation is fine and it will be fine for the next 5 years is probably the ones that will be vulnerable. The ones that realize that this is just a continuing change and everything's always changing going forwards, they're the ones that have probably got their shit together.
Second question from Fegan. Thank you for your commitment. How will leaving the single market and the end of passporting rights impact challengers?
I don't know. I really don't know. And I've seen so much, sort of pontification about what this will mean and, where Brexit will take us. But, I think we're looking at many organisations who are playing a game of, checkers on this one by moving into places like Ireland and whatnot to try and mitigate any inability to get into both the common market, but also access to a banking licence that would allow them to pretty much do exactly the same way that they would have been doing it anyway. So, is it going to cause them the inability to do it? Probably not, because there's ways around it. Is it going to cause them additional spend that they wouldn't have planned to be doing before, because actually they would have been able to use the UK as a leapfrog to do those things? Probably, but I'm still not convinced that actually we're in a situation where we 100% know what, despite people going on about Brexit is Brexit and all of these things and, laying out these principles and practices and where we're at. Fundamentally, we just still don't know. It hasn't been the dawn of the dead moment that we thought, that it was being made out to be in terms of the changes yet. We haven't seen the catastrophic changes in investment that were being sort of predicted as well. All of the talent hasn't buggered off to Luxembourg and Amsterdam yet. But I think, until we really have this is what it precisely means, then everything else is just guesswork.
I think it's the uncertainty that's the problem. I don't think it's going to impact execution and teams working, creating products now. I think it will impact people who are raising money or are trying to hire talent from abroad. I think they're going to be two areas where it impacts, because ultimately you've got to convince that VC that you have a large addressable market to go after. And obviously saying that we can passport a banking license or some kind of license into Europe gives you a much larger market, so it makes you more attractive. And equally, if we're hiring someone from, Portugal, France, Germany, and say, come across from Berlin to work on our startup, then they've got to keep an eye on, well, is this going to be possible for me? Am I going to move there only having to move back? So I agree that actually it's about uncertainty is the problem at the moment, because you can deal with things that you know about, yet if people are making decisions based on what the future might look like and we don't know what that looks like, that becomes super difficult.
Yeah, it's an interesting one. We just don't know yet, do we?
Well, I think it's it comes up a lot in panels and discussions and sort of interviews, but it doesn't come up a lot in day-to-day work at startups. I mean, ultimately, you've got to execute. You've got to take your idea. You've got to make it live. You've got to test it with customers. You've got to build it, and you work with what's in front of you in order to do that. So it's an interesting one that comes up more on the kind of commentary side. What do we think is going to happen than the day-to-day? But I think that the day-to-day piece is around fundraising and talent, which is where the impact will be.
I think the fundraising part of it, I actually don't think will be so impactful. I think the talent side of things, I think, is an interesting one because of the unpredictability of the nature. Arguably, the day one problem is going to be much less, because actually most Europe and the UK is going to be starting at the same point. There's no way we're going to rewrite every legislative approach for day one, but arguably the problem will be maybe not from an operating cost from day one, but 5-10 years out, if the two legislative systems drift apart, and actually the complexity of adhering to one and the other is going to significantly add to the operating cost of it, then actually it sort of reduces the ease in which people can move to the UK from Europe as well as from the UK to Europe. So I think it's going to be a really interesting one. I think the UK and Europe would probably be quite foolish, or particularly the UK would be quite foolish to move too dramatically away from actually everything that's in place with Europe at the moment, because we've got a pretty good thing going on. So why change it if it's working?
Try saying legislative after 2 beers.
Try saying what, sorry?
Legislative.
Right, yeah.
And on that note, that probably wraps us up for another week. So super good to be back. If I'm not back next week, then they'll tell me it was better when I wasn't on. So we'll have to see how that goes. But thanks for tuning in. If you'd like to get a question answered, please go to either drop us an email or send us a message on fintechinsidernews.com. So that's it for this week. Catch you next week.
Bye.